The real John here. One handle, one identity, no confusion. You'll see the name in a lot of places now because when a format works, people imitate it. That's how the internet operates. But the one thing that never lies is continuity. The handle stays the same, the data stays consistent, and the perspective doesn't change just because the market gets uncomfortable. If you're here, stay with me through this entire breakdown, because every part of this story connects to the next. If you skip around, you'll miss the exact mechanism that explains why silver could trade near 94, rip higher, then collapse toward the high 80s within hours. While the world is quite literally on the edge of an energy shock and China is hoarding metal like there's no tomorrow, over the weekend, while most Western traders were offline, something important was happening. Markets that actually deal in physical metal were still open. They were still trading. They were still discovering price. And that price discovery was not subtle. Silver wasn't hovering politely in the low 90s. It was pushing toward triple digits in places where delivery matters. Gold wasn't calmly sitting near Western spot either. It was trading far above it. Those prices weren't predictions or opinions. They were live transactions backed by real metal, not paper promises. When traditional Western markets finally opened, they didn't start from a clean slate. They gapped. Silver jumped hard, gold punched upward. That opening move wasn't random excitement. It was the Western system playing catch-up to information it had ignored for 2 days. At first glance, it looked like confirmation. The gap validated everything the physical markets had been signaling. Anyone watching closely could say, there it is, the move has begun. But markets rarely give straight lines, especially when sentiment gets crowded. What happened next is where most people get confused, frustrated, or shaken out entirely. Silver didn't just pull back a little, it was hit aggressively. Within a very short window, it was driven down hard, wiping out hours of gains and flipping the emotional tone from euphoria to panic. Gold, meanwhile, held up far better. That divergence is the key to understanding what's really going on. To understand it, you have to look east before you look west. While American traders were reacting to price candles, China was reacting to scarcity. Retail gold prices across major Chinese platforms surged to levels that looked absurd if you were comparing them to Western spot. But those prices weren't theoretical. They were what people were actually paying. And then something even more telling happened. The gold ran out. Investment bars disappeared from shelves. Stores stopped selling them, not because demand slowed, but because inventory was gone. What remained were decorative and crafted pieces, priced even higher, reflecting both metal value and craftsmanship. That isn't a technical anomaly. That is what real demand looks like when it collides with limited supply. At the same time, China's largest online financial platforms experienced severe strain. Systems slowed, logins failed, transactions stalled. This wasn't a glitch caused by boredom trading, it was volume. A massive pool of savings tried to move into gold all at once. China sits on an enormous amount of domestic savings, and when even a fraction of that decides to shift direction, infrastructure feels it. Banks reported surges. Miners in China hit daily price limits to the upside. This was not quiet accumulation. It was loud, frantic, and urgent. Here's the part Western investors need to pay attention to. Chinese mining stocks surged, but Western mining stocks largely didn't. Historically, miners exaggerate the move in the underlying metal. They tend to lead when a bull market is real and broad. When you see miners in one region exploding higher while miners elsewhere hesitate, that gap is information. It can signal opportunity, but it can also signal caution. The difference lies in whether the hesitation is ignorance or intent. That's not something you resolve with a headline. You resolve it by understanding the broader regime the market is entering. Now, widen the lens beyond metals for a moment. This isn't just a story about silver and gold. It's a story about energy, geopolitics, and control. The conflict involving Iran is no longer confined to rhetoric or isolated incidents. Multiple countries and installations have been hit. This includes critical military and energy infrastructure across the Middle East and beyond. Major refineries are offline. Liquefied natural gas facilities have halted operations. Shipping routes are under threat. These aren't symbolic targets. They are the arteries of the global energy system. When a major refinery processing hundreds of thousands of barrels a day goes down, that's not noise. When a country responsible for a significant portion of global LNG supply halts production, that's not a footnote. European natural gas prices didn't spike by nearly 50% in a day because traders felt emotional. They spiked because supply risk became real, immediate, and measurable. Flights were canceled. Military assets were lost. Political leaders signaled escalation rather than restraint. By any traditional logic, oil prices should have exploded higher, and yet they didn't. Oil initially jumped as expected, but then it faded. It drifted lower, almost casually, as if nothing of consequence had happened. This is where understanding markets as mechanisms, not moral judges, matters. Price is not a pure reflection of reality. It is a reflection of positioning, leverage, and control. When large paper positions dominate a market, they can suppress price temporarily, even as physical risk builds underneath. This doesn't make the risk disappear. It compresses it. Think of it like a pressure vessel. The longer pressure is held down artificially, the more violent the release tends to be when control slips. This separation between paper markets and physical reality is becoming impossible to ignore. You see it in oil, where supply disruptions are shrugged off by price. You see it in gold, where physical premiums in Asia blow out while Western spot pretends nothing is wrong. You see it in silver, where Eastern markets maintain large premiums even after Western prices are smashed lower. These aren't isolated quirks. They are symptoms of a system under stress. Now let's come back to silver, because this is where emotions run hottest. Silver sits at a crossroads between monetary metal and industrial commodity. Roughly half of its demand comes from industrial uses: solar panels, electronics, electric vehicles, infrastructure, defense systems. When the world faces a sudden energy shock, markets worry about growth. Factories don't hum confidently when fuel is uncertain. Supply chains don't expand when transport is threatened. In those moments, assets tied to industrial expansion get punished. Gold doesn't share that vulnerability. Gold isn't consumed. It doesn't care about factory output. It cares about trust, stability, and currency confidence. In a growth scare, gold leads and silver often lags. That explains part of the divergence, but not all of it. The speed and timing of silver's drop matter. A sharp sell-off concentrated right before the New York session fully engaged isn't just macro adjustment. It's also positioning. Markets have a cruel sense of humor. When sentiment becomes one-sided, when everyone starts expecting a straight shot to higher prices, the market often does the opposite, at least temporarily. Late buyers pile in, stops cluster, liquidity builds, and then price is pushed just far enough to trigger fear. This isn't personal. It's structural. Large players don't make money by agreeing with the crowd. They make money by exploiting the crowd's reactions. Massive positions are not passive bets. They are tools. Algorithms are designed to amplify emotion, to shake confidence, to force weak hands out at the worst possible moments. The irony is that the people most harmed by these moves are often the ones who were directionally correct but poorly timed. Through all of this, one thing quietly held: the premium in Asia. Even after the Western sell-off, silver continued to trade significantly higher in Shanghai. That premium didn't collapse. It stayed. That tells you something crucial. Paper price fell, but physical conviction did not. When a market shrugs off a price smash without seeing demand evaporate, that's not bearish confirmation. It's tension building. There are real risks here, and ignoring them doesn't make you smart. It makes you blind. Technically, silver did break down from its highs. Key moving averages matter, especially on shorter time frames. Failure to hold them can open the door to deeper retracements. Western miners lagging their Eastern counterparts could signal that institutional capital is not fully aligned yet. These are valid concerns, and anyone telling you otherwise is selling certainty they don't possess. But risks don't exist in a vacuum. They exist alongside facts that haven't changed. China just experienced a physical gold buying surge so intense it disrupted systems. Retail stores ran out of investment bars. Savings looking for protection found metal. Energy infrastructure across the Middle East has been hit. A structural silver deficit that's been building for years didn't vanish because of one brutal morning candle. And oil prices behaving calmly in the face of chaos doesn't mean chaos isn't real. It means suppression is active. The unresolved question hanging over all of this is whether informed money is positioning ahead of something larger. Markets don't move violently for no reason. Sudden slams and suspicious calm often precede transitions. You don't have to predict the exact catalyst to recognize the setup. You just have to stay rational when others get emotional. That's the real takeaway here. This isn't about calling a top or bottom to the dollar. It's about understanding the game being played. Physical markets are speaking loudly. Paper markets are trying to maintain order. Geopolitics is applying pressure. Energy is the fault line. Precious metals are the signal. If you approach this with hype, you'll get chopped up. If you approach it with logic, patience, and data, you give yourself a chance to navigate what comes next without panicking. Follow the information. Watch where physical demand refuses to die. Pay attention to what prices do not do when they should. And above all, don't outsource your thinking to headlines or crowd emotion. The market doesn't reward certainty, it rewards preparation.